Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, July 25th, 2019. It is about 1:45, actually 1:46 exactly, Eastern Time as I'm starting this video. And I wanted to do an update on the metals. That's where obviously a lot of my focus has been lately, and a lot of the trading opportunities. So we have, with gold, the bigger picture, if you're new to the site, is this. I, remain and have been persistently long-term bullish on gold and the precious metals and miners for quite some time now, even heading, even late last year, and even beyond, back here as well, looking for a bottom in gold, made a strong fundamental case back in late 2015, both technically, that huge bullish divergence on GLD right here and gold, futures as well. And I did a video talking about showing you how crude prices had collapsed and how uber bullish that was. You had, like any bear market, just like the stock market, think back to 2009, valuations always swing to both sides on the pendulum. At the end of a bull market, valuations on, for example, here on gold or the stock market at the bull market highs are always excessive, and then they swing to the other side where everything's cheap at the bottom. So you couple the technicals on gold with falling oil prices, and that sets a bullish backdrop. Now, so that is one factor. And again, why? Because crude oil is energy, whether it's electricity bills, for the mining companies, warehouses, operations, conveyor belts, all this other stuff, or of course the fuel that goes into the trucks and the machines that mine and pull the gold out of the ground. That's obviously a pretty decent expense to them, just like airlines, pay, fuel is the second largest cost to airlines. So that also helps. It goes into play here. That was that plunge I was talking about then, and that's why I was very bullish on gold back then. And same thing here. We had crude oil has again plunged, and we're not far off those lows. So energy prices remain really low, and now that's just one variable. Much more important than that, and this is where I'm going to roll into here, is the euro or the US dollar, because the gold you and I trade. Now, you may live overseas somewhere, you may be trading gold based in other currencies, but most commodities like oil, for example, these, the standardized currency, the exchange rate, it's traded in US dollars, bought and sold throughout the world. And gold, at least here, we're trading GLD or gold futures, GC, these gold mining ETFs, and so therefore the dollar is a huge determinant of where gold goes. And I've done this many times, but I know how people always come into the site, so I'll do it real quick here. Come in here and show you what it looks like when we overlay. There's a chart overlaid. I like to use the euro US dollar. It trades well. It's a proxy for the US dollar. The euro is by far and wide, with even a distant second being the Japanese yen. The euro is the largest component of the dollar index. So when I look at the euro US dollar pair, it's just a dollar in reverse. So therefore you want a positive correlation. When the euro goes up against the dollar, that's bullish for gold. And you can see there are always temporary disconnects, but to me this chart is unmistakable, and I've done this many times. You can go back as long as you want. And the point I'm trying to make is when the dollar falls, that is bullish for gold, and it's simply because a falling dollar, when the dollar falls and depreciates, it takes more dollars to buy an ounce of gold. When the dollar rises and appreciates in value, it takes fewer dollars to buy an ounce of gold. So that the relationship, it's really simple. It's not rocket science. That's why it works. That's the hows. And then this is the proof that it does work. And then every now and then we'll get somebody who says, oh no, they're not positively correlated. Any two asset classes, I don't know of any that I've ever studied with a strong correlation or inverse correlation that don't have their temporary disconnects. And in this case, the disconnect I view as bullish, because you can see when we zoom in here, the euro's been falling, meaning the dollar's rallying. These candlesticks here, the green and the red. Yet gold's been going up. That is that flight to safety bid. We all know the stock market's days are numbered. And I've been saying it for a long time. A lot of people have. The market's really not gone up anywhere. It's up 2% over since the the highs back last fall in 2018. But yet it hasn't gone down either. But you're seeing a lot of money flowing into gold. This is, again, the white line is gold, and that shows you this is just the the supply, I'm sorry, the demand component for it. The demand, not for industrial uses, because most industrial metals had been weak. The economy has been softening. So it's that flight to safety component, people buying gold. And now add in a rally in the euro and a drop in the US dollar, and that'll be like hitting the turbojets. So again, I just wanted to point out there's a lot of variables that go into my analysis. I use technical analysis, that's charts, and fundamental analysis, things I just talked about, such as falling crude oil prices being net bullish for gold, especially the mining stocks, of course. That's the ones I'm referring to. And then again, of course, the U.S. dollar. So let's examine the dollar here. Let me get rid of that comparison there. So we go back, and this is the 10-year chart right here, 10-year weekly chart of the euro-U.S. dollar forex pair. And you can see back here we had a big, strong, multi-year divergent low. That was the catalyst for this rally. These things don't come out of nowhere. Very often they're just priced into the charts. And sure, you can retrofit the headlines, the fundamentals, and all that. But again, it was priced into the charts, just as at the high, and all these were pointed out at the time in advance. We had a divergent high right there, and then we had a trend line, beautiful uptrend line right there. It broke, and that gave you your sell signal. And so then the euro fell. This is that big rally in the dollar. And now we've come full circle. Recently, I've been highlighting, well, for many months, for over a year now, I've been highlighting and waiting for this bullish falling wedge, stating repeatedly, throughout 2018, that the next major buy signal in gold would come on a breakout of this, and we did. We broke out. Now remember, this is coming in for a back test. That's why I wanted to do the video today. But it doesn't matter, because gold has continued higher, even with the euro pulling back and the dollar continuing to rally. So it's played out well. Like I just said, gold has somewhat ignored the strength in the dollar, at least through the recent rally. Most very short term now, for the last few weeks, it's been consolidating. And, and I've warned of that, silver running into resistance, some divergences, overbought conditions, and I think it's a consolidation. So what I wanted to do the video is point out, when I zoom in here, the euro-US dollar pair, that's the weekly chart. There's the bullish falling wedge, breakout, and now a back test plus that 11. I have the 11,240-ish level. That's price support if you zoom in a little closer there. And again, here's a weekly chart. You got to give it a little room, but you can see there's that's what's been containing the prices, and it's not just recently. Back here it was support as well. Back here it was support. Here it was resistance. There it was support. Sounds like Old MacDonald had a farm, but either way, you got it. Support, resistance, support, resistance, support. So a pretty big level right there. If it goes, that's not good, obviously. Support is support until unless broken. If it breaks, I don't have a lot of really solid support for the euro down to there. That would mean the dollar has another leg up. But that hasn't happened yet. And when I look at the daily chart here, this is that same wedge zoomed in a little bit on a 2-year daily chart, and you can see here's the trend line on that wedge right there. I have alternative trend lines here. I have a draw one right here, and they come in roughly together. Bottom line is, you have a breakout, back test number 1. We rallied up, we hit. Remember, I had a second alternative trend line right there, which was another target. We hit that, we reversed, and now we've come back down to back test the trend line. This is TA 101. You take a long side, you get a buy signal on a breakout of a bullish chart pattern, or on a back test, and this is just a second back test, another lower level back test, and it also comes in with some price support. So while I can't guarantee that we reverse from here, I can tell you right now that is absolutely an objective long entry. I don't trade forex. I really just chart it to get an idea of where gold's going, or at least to confirm or refute my analysis on gold. And right now it's telling me, hey, the euro US dollar is back testing dual intersecting support levels, price support and the downtrend line right there. So if it can move on up, we've already tested this trend line once. As I often say, the initial tag of a resistance level from below usually produces a reaction. That's why I list multiple price targets. You can game those trades. But the second time around, if we get there again, even if we have a little reaction first, which, coin toss odds in my opinion, we'll probably go on through it eventually, whether we go right through it or have a little reaction there, and then run up to my next target zone. It's about 115-ish on the euro. If that plays out, again, that would be bullish for gold. So that's why I wanted to start the video out and spend so much time on the currencies. And today we had, ECB meeting. I haven't even read the commentary. Somebody said they were uber, and that's what we've had since the financial crisis. They call it the race to the bottom, with all these major global, all these countries one after another trying to debase their currency by quantitative easing, keeping rates low. And so we cut, now they cut, that kind of thing. Either way, let's just try not to. I don't try to read too much into what's going to happen. What are they going to say? Let the charts be our guide, and that's why I wanted to look at this euro US dollar pair. If we zoom down to the 60-minute chart to try to hone in on an entry here, you can see the last time we had a bullish divergence right here, divergent low was back here, and that led to a nice pop in the euro and ran right into a well-defined resistance. That's a target I had there, about 112. 802. You can see we hit that resistance level numerous times, so it's a big level. And now I'm pointing that out because if we start to rally from here, we need to clear that level. If we do clear it, that will be very bullish if we clear it with conviction, because there are a lot of reactions on that level, not just one or two. The more reactions you have, the more valid a level. And then when you break support, when you see this impulsive selling, that helps to validate it as well as an important level. So here we are on the 60-minute chart. We have a downtrend line that was popped today. We've come in and back tested it. So far we're holding it. This has nothing to do with that larger wedge I just showed you. This is just a smaller 60-minute downtrend line, little price channel here with positive divergence. So that would indicate, if the charts play out as I suspect, we reverse from here, go up. The first big level right now, I can tell you, I've made a mess of this chart, but let me just color code these for you. Yep, did the wrong tool. I deleted that line. I had a line right there. I wanted to give you roughly 112. That's a pretty big level. You can see how it acted as support along here. So these are kind of micro levels. And you may be a Forex trader, and if you are, give me a shout out. I'll, if anything that has a chart, I can chart it, and at times I'll trade it. Again, I'm just using this to kind of align my trades on the precious metals. So enough on that. Let's move on. We'll see. And again, if it's all just peters out here and we run on down through here, there's some room for these divergences to remain intact if we undercut those lows briefly. And again, going back to the big picture, guys, don't get tied up so much into the short-term charts. I use the 60-minute charts, the intraday charts, to help hone in on entries and exit points. Find levels that may be the catalyst for a breakout that may lead to a bigger breakout on the more important daily and weekly charts. But on these weekly charts, you have to give it some room, because intra-week you can break below support and then close the week back above it. So that's the euro US dollar. Now let's roll in back into the metals and we'll kind of wrap this thing up. So again, gold, longer term, bigger picture. There was your, here's a downtrend line, an important downtrend line. It was a big symmetrical triangle pattern I've been watching for a long time. We're bouncing, compressing. We broke out recently, back tested, ran up, hit my 130 target, and exceeded it, overshot it. And so far, we've been consolidating above it. And as I mentioned, any pullbacks to that level is still objective entries. We may not get it, because when gold wants to run, at times, it can really run and burn through, resistance levels, divergences. Back here, we had that strong run off the 2016 lows. But, sometimes, sooner or later, you get consolidations when things get very overbought before you get the next leg up. So whether this is enough to work off the overbought, I can tell you we're still overbought. You can see on the weekly chart, and that's why I'm leaning towards some more consolidation. Somebody asked me on the front page post today under the charts I'm watching, when do you think the next objective time is to add some more to gold and silver positions? My answer is, look, I am near-term neutral to slightly bearish. I think there's a little more downside. We're going to get to the 60-minute charts here in just a second. But I've also traded gold enough and the miners many times for many years now to tell you that when they want to run, they can run and they can burn through divergences, and they can make overbought stay overbought for an extended period of time, especially in a strong bull market. Now that was the end of the bull market there. That was kind of blow off top, but I just wanted to point that out, that they could run. So my answer to that is, look, if you're an active trader, a short-term trader, let's just flip over right now to the very short-term charts. Here's the chart I posted on the charts I'm watching this morning, trading up on silver. And we had a nice clean bearish rising wedge pattern. I have parallel trend lines, and this is my what I call the BOD, benefit of the doubt trend line. You can see why I have it. Comes in and catches a few reactions that this first trend line, which catches a lot more reactions. And I'm talking not the bottom of the candles. When I draw trend lines, I use either the body, which is the fat part, or the wick, and whichever we have most reactions. So I think these were both valid, but this is, like I said, the benefit of the doubt. I call it the second of the two to break. And then after we broke it, we back tested. And then you can see we came in and back tested, and we were right here this morning, so we fell almost to the penny. Remember, unofficial trades, if it's official, I make it very clear. Official trades, which this is not, because it's a quick, active trader type trade. It's not for your typical swing traders or investors, or the majority of people that are members of the site that work a full-time job. You can't be in and out of the these things. This trade only lasted a few hours from where it was posted this morning to that target was hit. But what I wanted to say is, if I do an official trade, it'll say T1 equals, and in that case I've always set on a long trade, the target will be set just below the actual resistance level I expect it to reverse at. And on a short trade, it's going to be just above my target. So if 16.335, that's where the line is, that's support. You don't want to hold out for 16.335. You want to cover a little bit above it, because what happens is, when all eyes are looking at the same level, you're likely to get the buyers step in early. And I just wanted to point that out. So my position, I reversed a little shy of that. Same thing back here, 16,120. If we break, I'm still long. And what all I'm doing now is just trailing up a very tight stop. And if it gets much higher, no, I'm not going to reverse back short yet, but I will probably just cash out if we get right here. I just wanted to gain a little bounce. We have a little more upside, about 16. I'll have to study. We're about there now. In fact, hold on one second. Let me type my stop again. Okay, that's what I did. I just put a stop at 16.445, a little below. And again, just to, my intention was originally just to play a little bounce trade. That's when I show you arrow breaks too. I don't always draw out every little zig and zag. An arrow break would just mean, you hit a target, you expect a reaction, and then the next break of that level, should we get it, that would be your next sell signal. So you can either short a bounce back or short a break of 16.335. And again, this is short-term stuff. And if you want to know the ideal place, if we get down here at that 16,120 and then gold gets down, I showed you a chart of gold as well. I've just been more hyper focused on silver lately. It's where more bang for your buck on the upside. It's been playing that game of catch up to gold. And then in doing so, of course, it gets a little more overbought. Where's gold? Here we go. So gold broke down. I have all, various trend lines here, and gold broke that one today. But gold still is above the this support here, about 1402 and 1387. So where I'm going with this is, and this was my answer to that member on the site today. If we got down here again, I think that's a pretty good level to add, especially if the charts confirm at the time. Maybe we come down and undercut it. If we did, there's a possibility, if it happens soon, that we could put in a divergent low, look something like this. So that would be, those are your divergence lines. Gold comes down here. If we broke 1387, you'd see a quick flush down. Why? Because there'd be a lot of stops. There's a lot of traders probably looking at this consolidation zone, this consolidation range right here, and seeing that same level I am. And so, and this is what I used to do years ago, but I've kind of learned, I don't always get it right, but I try to anticipate, think like the market makers, think like the powers that be, whatever nefarious forces are in the markets, whether it's algo trading programs. But I know enough to know a lot of retail traders would have stops just below that level. And so if you break it, the stops get cleared, you wash out those, flush out those weak hands, and then reverse it. And so that's just one of many scenarios, and I'm just showing you what I'll be looking for. And if it starts to materialize, I'll probably play that scenario, whether I go long on the breakdown with a stop a little below, or whether I wait for the reversal. That's a little higher probability entry, but a less favorable price. But until then, like I said, I've kind of stepped back, lightened up. I mentioned taking some profits on the miners, but still holding core positions in all of this. And that's the other thing I want to say. I wear multiple hats. I'm a long-term investor, trader. I have long-term accounts, college funds, IRAs, and I also have an active trading account. So I'll have a core position in gold, in the mining stocks, that I may lighten up when we get a little very overbought. It looks like a correction's likely, but I'm not going to go out of close that whole position out until anything changes. I'm trend trading those positions. But I will lighten up, and then I'll add back at appropriate times, and that would be one of those times. Now, I may not get that, and that's what I said in that my reply today, is that I've seen gold sometimes just kind of burn through these divergences. I mean, at this point, yeah, it would be burning through. We haven't had much of a correction. The correction's been more in time. It's been consolidating. But I'll have to say the divergent high wasn't until this point. Right here, we didn't have divergence. This is when you had the negative divergence, when you made that higher high. So I don't know. That's my favorite scenarios. A little more sideways action, maybe a little more downside in gold. But if it can start to run up here and burn through these divergences, maybe the next leg up is at hand. And again, sometimes that entails me having to buy back into those positions at higher prices than I exited. And so be it. But if, again, I'm looking, playing the long game here, and the long game tells me that gold is going up here at about 151 or so, or maybe 150, and that's another 10% higher. And if gold does that, then the mining stocks will do an order of magnitude of that. Mining stocks probably run up here about 40%, up to about this 28-ish level. And so therefore, if I have to chase, buy back in, if I don't get to pull back an ideal, objective long entry or re-entry, which in this case would be like something like this, pull back to that 25-ish level, 26, 25, and then move up to my next target. That's how I foresee this one playing out, like that. Okay, I'll loop back to GDX. That's where we're at. I know I'm kind of all over the place here, but there's just I don't trade the miners or gold or silver, anything in a vacuum at all. To me, they're all interrelated. Even with that disparity that I pointed out recently in gold and silver, and talked about the catch-up game that silver would play. That all kind of it all goes into that's why I was more focused on silver and the silver mining stocks recently than gold, which I had been focused more on up until recently. So there's a big old gap right there. So that would be, I'm just pointing out levels that if we get a pullback to that level, and that's also the bottom of that recent consolidation area in gold. And you can see here we put in a divergent high on the daily time frame. There's your negative divergence, just like we had a divergent high here. That was pointed out at the time then, negative divergence. And it kind of gives you that heads up. This divergence could extend. I want to point that out, that if we happen to thrust up now and come on up here, we could put in another, we had a divergent high at this point right here, divergent high 1. We pushed up, made another high after a little bit of a correction. This time around, it's a little bit, this is not a great trend line. I'm not crazy about this trend line, but you can see we've sliced through it. If I tried, I can't get a good fit with a lot of candlestick reactions. So I'm just going to leave it there and say that we're kind of cracking below it now. And again, I think I've said it enough, but I want to say it again. My convictions aren't very high on the very near-term direction. Longer term, you ask me where I think gold is going, and this could change. I will change my views if the charts change and things convince me, the dollar does something crazy, but I still, have a pretty high degree of confidence there's more upside if you're looking out, 4, 6, 9 months out on gold. Near term, it's tough. You get in these consolidation ranges, and sometimes the charts will give you clues. There's not a lot right now. And so, like I said, I'm near-term neutral, which means maybe more grinding around to cautiously bearish, a little more downside here. And I really wouldn't want to see gold go much below the bottom of that gap around 127.45. So that's GLD. That's the daily chart. 60-minute chart, that's the best trend line fit I could have. That's a similar wedge to the one I showed you earlier on the futures. GC, the futures contract, you can see GLD breaking down, and here's some support levels you can target on a pullback, which would be objective entries. And again, because of the strong rally in gold, especially if the euro reverses here and the dollar starts dropping again, at that point I can tell you I would favor the shallower targets right here, like 130, versus the deeper targets like 125. SLV, that's similar to the wedge I showed you on silver futures, which earlier, that's silver futures or SI. You can see a breakdown there below, and it's pretty thin. Yeah, we have a bottom of the zone right here, support zone about 15 or so. So that would be, these are all levels. Remember, we already hit my first target, which is my minimum target, and that may be all it is. That's comparable. I'm giving you the comparable levels on SLV if you want to trade those, about 15.26. With that, if we break that level, then we probably come on down here at about 15.04, which again would be that lower target on SI that I showed earlier. This is SIL. We're still on a 60-minute chart, so I'll just leave it here. Silver Miners ETF. You're getting that divergence right there, and you had a heck of a run. It says, kind of heads up. Kind of get a little ahead of ourselves here, and they may need to take a breather. That's what it looks like on the daily chart. Negative divergence as well on the daily chart. So I can be pretty clear. Is it the most objective time to add? No, it was more objective back here on this trend line breakout. I pointed that out. We had the trend line breakout back test. We may need to consolidate. We can burn through the divergences, and if so, those are the additional targets. But near term, it's just not that objective to add right now. Let's look at SILJ. That's our active trade. So we already hit and exceeded our first target. There's the additional targets. And again, there's not enough in the charts here to have me pull this trade right now. I think it's prudent to raise your stops. If you took it when we did, I haven't changed the stop on the official trade. I'd probably do that. I would almost certainly do that if we hit up here around T2. But again, near term, I don't know. It's kind of obscure, really. The charts are as to where we're going, but we'll watch that US dollar again. If the US dollar here, let me show you something else. I showed you the euro. Keep talking about the euro US dollar pair. Here's the dollar ETF UUP, and you can see just like the euro is back testing its bullish falling wedge, UUP, the dollar ETF, is back testing, and it still has that divergence in place as well. Except that's negative divergence, of course, on a rising wedge. There it is. So we made a slightly higher high, or an equal high, slightly higher, and you have the breakdown and back test so far. And this doesn't do a perfect job. It's an ETN that tries to track the dollar index, but again, you get the gist of it, that is a back test. And also the dollar, as I pointed out, at a pretty major resistance. I just flipped over to a long-term chart on UUP. And there it is. So there's your wedge, there's your weekly divergences. These are big. These are what I look for, the major trend changes. So negative divergences on weekly time frames. Back here we had positive bullish divergence. That gave you that huge rally in the dollar. That culminated or ended with this negative divergence, big drop, biggest drop in years, and that ended with positive divergence. So it's watch, rinse, repeat stuff. I cannot guarantee that these divergences play out, but I can guarantee more often than not they do. And trading, it's all about odds and probability. That's why I like trading stocks, and I don't go to Vegas. The odds are against me if I walk into a casino, whereas you trade these chart patterns and setups, and you're putting the odds in your favor. Okay, I will wrap it up here, and I always say this: charts are dynamic, and therefore so is my analysis. So if I start seeing the dollar moving up or down, I should say, the euro starting to rally, the dollar moving down, and that back test holding successful, maybe gold and silver start to move out of this, or maybe they don't even break out of the range yet. If I see enough in the dollar, I may change my tune, and then start adding back those positions. I told you I took some profits on some of the miners recently in some positions, and right now I'm just kind of in day trade mode with the metals, as long as they're in this consolidation range. But if anything changes, and I think it's maybe a good time to add into longer positions, or for those of you that might have so far missed the move and you're looking for an objective place to buy in, I get that. I'll try to convey my thoughts there as well if I think it's time to maybe start layering back into the metals and the miners. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.